Hello, my name is Matt Shanahan. As Lindsay indicated, I'll be taking us through the presentation today. As the Chief Strategy Officer, my role is to guide product investment by looking at ways we can help companies lower their total cost of receivables. I spent a lot of time talking to customers about their challenges, their priorities. Lately, the conversation then with CFOs and controllers about reducing DSO as a key goal to lowering the total cost of receivables. First, a quick background on Anytime Collect. Anytime Collect not only lowers your total cost of receivables, it makes your bank balance bigger. Anytime Collect is in use by over 170 companies globally and has more than 10,000 daily active users. At Lockstep, we think connectivity has the power to unlock productivity and business benefits. Our integration platform has the most number of connectors in the industry, and we're adding new connectors every single month. If you don't see yours on here, let us know and we can add it. We also have deep expertise in optimizing receivables for companies. We process millions of invoices monthly, and there are more than 3 million invoice companies in our platform. And over time, we've helped suppliers collect billions in cash. Today's webinar is the second in a 4-part series on reducing DSO. The first webinar introduced the concept of sequencing and how it impacts DSO. Today's webinar will focus on the top metrics for collection. Part 3 will dig into how AR sequencing can be used with a digital portal. And Part 4 will look into how you can build and manage your own AR sequencing. So let's go into this a little bit more detail. First, we want to recap part 1 of the series just to provide some context into the discussion today. CFOs, controllers, and credit managers we've been talking to have really want their teams to focus on customer service activities that unlock cash. For instance, providing reporting support to high-value customers to accelerate their internal approvals, being able to get payments done more quickly. Also, another great example is resolving disputes faster. The typical dispute can take 2 to 4 weeks to resolve. Cutting that by more than 50% can have a dramatic impact. The challenge, they say, is that too often their staff is caught up in transactional communications required for collections. They also say that not staff to meet all of the desired policies and procedures and end up focusing only on the latest payments rather than all their payments. That's one of the great things about AR sequencing. Accounts receivable sequencing is a solution that frees up that staff time from transactional communications so they can focus on customer service activities. AR sequencing is really a set of intelligent rules that automates credit, collection, and payment policies by sending outbound communications and assigning staff tasks. Examples include automation of credit policies, such as when to place someone on credit hold. AR sequencing can also automate collection policy, such as when to send past due reminders or place a phone call. AR sequencing can automate payment policy, such as to whom should an offer of early payment discount be offered. Sequencing is one of the most powerful solutions available to an AR team. It creates a significant increase in outbound communication capacity and saves a massive amount of staff time. This example is an AR sequence that automates collection policy for past due payments. When an invoice goes past due by a week, an automated past due notice is sent, including instructions on payment. After 2 weeks, an automated past due notice is sent out, but this can be modified in tone to indicate the rising severity of the situation. The automation of policy happens right through the final notice being sent, and then the assignment of an AR staff person to reach out to the customer for conversation and a plan forward. As you can see, the sequencing can free up a lot of time, much of which had been manual writing and sending of transactional communications. The focus of the webinar series, as we talked about, is reducing DSO because of the benefits it provides. First, it increases your bank balance, which means you have more working capital to invest in the business. That working capital also increases your cash from operations by reducing interest expense or increasing interest income. What we also witness is the reduction in DSO is accompanied by an increase in operational efficiency, as shown by the AR sequencing. Finally, since the drop in DSO increases liquidity and profits, there's an increase in shareholder value. And these are really the drivers that we've seen as we work with teams. So now let's look at part 2 of the series, metrics. The good thing about accounts receivable metrics is that there's a lot of them. Average days delinquent, collections effectiveness index, turnover ratio, aging by bucket, invoice exceptions, write-offs, and there's more. There's lots of different metrics. The bad thing about AR metrics is there's a lot of them. So which ones do you focus on? Today we'll focus on 3 metrics that we think have great value in the collections process. And you might be thinking, how do we know they're valuable? This is a simple but useful way to think about any metric with which we work. The value of a metric is the amount or the improvement, if you will, or reduction in risk in a decision that has economic consequences. Basically, is my decision going to yield me a higher either revenue or reduction in loss based on doing that? And as you can imagine, collections has a lot of decision making that has real economic consequences. I think that's one of the sort of the challenging things of the environment. And so when we looked at our metrics, we really looked at them from this angle. So let's dig into the 3 collections metrics. The first one is days sales outstanding. Days sales outstanding, also called the average collection period, measures the number of days it takes a company to collect cash from its credit sales. DSO is used in a number of different ways. First, it's the one of the primary metrics in the company's cash conversion cycle. And that looks at both the inventory, the payables, and the receivables. So it's an important part of a CFO's view of how cash goes through the company. Second, it's a measure of the liquidity that describes how quickly assets can be converted into cash. It also is a measure of collections effectiveness. In other words, the DSO measures how well a department is in collecting cash from the customers. The sooner it can be collected, obviously, the more effective the operations are. And while DSO doesn't measure efficiency because DSO isn't able to look at the cost side of the collections, it can indicate changes in efficiency. And so it's an important thing to track and be able to understand, is something going wrong with the process? And it's really this ability to track and report effectiveness, as well as the ability to indicate potential changes in efficiency, that makes DSO so important. It allows you to track your performance over time and then be able to understand whether the changes in your policies and procedures are actually working. Oftentimes, an AR team has to manually calculate their DSOs. Anytime Collect automates that calculation. The calculation we use is a standard DSO calculation, where it looks at the current receivables divided by the total credit sales in a period of time. We use rolling 6 months for that that DSO calculation. But we also know that some business models require custom DSO calculations. So we support the ability to implement custom DSO within the system. Now that's important, as we talked about, because that ability to view not only your current DSO, but also track over time is critical. So in Anytime Collect, there's a month-by-month tracking that gives you a trend line indicating a certain pattern or direction that the DSOs are moving. Using that DSO trends can help decide whether the policies and procedures are working effectively. Even in the case of a seasonal business, you can look at that variation by looking at the same month's metric year over year. Let's say, for instance, you wanted to understand, by changing the past due notice frequency in your policy, does that, reduce DSO? So you'd actually be able to take a test group of individual customers, put them into that new policy, implement it, and then track whether or not it had a significant impact on DSO. You can also use it to evaluate things like not just collection policy, but credit policy and payment policy as well. Now, every company is different, and consequently, there is no set DSO amount that indicates good or bad receivables management. Therefore, when analyzing your day sales outstanding, it's good to benchmark yourself against others in your industry that have a similar business model. Anytime Collect provides these kinds of benchmarking opportunities as part of our service. The next metric is average days late. It's a behavioral metric that looks at the payment pattern of an individual customer. Average days late lets you predict a customer's payment behavior. And as a result, predicting the invoice payment is valuable in the collections decision-making process. First, a prediction of payment behavior can let you know if a customer normally pays you on time or not. And if not, how late do they pay you? Based on your policies, you may allow for some amount of past due if a customer is a reliable late payer and the balance is not above a certain threshold. This type of prediction allows your collection staff to save time from outreach when you know you're already going to be paid. It's just going to be paid late. Second, average day sales lets you know if the payment of a particular invoice is outside the normal behavior for that customer. If the balance of that invoice is above a certain threshold, your policy might be to reach out early and seek a promise to pay or check their financial position so that you can minimize your risks. The importance of this metric is that it drives decision-making that increases the efficiency of your staff and also really lets you identify your highest risks so that you can prioritize mitigating those. In Anytime Collect, there's two average days late calculations. Average days late is calculated as the sum of all days past due for all invoices of a particular customer divided by the number of invoices that they have. Average days weighted takes into account the open balances. So it can catch issues such as large invoices, summing up to be a potential risk. So there's two ways to be able to target those in sequencing. Now, the benefit of average days late is that you can start to predict payment behaviors and predict payments as they looking forward. So knowing customer payment behaviors lets you predict cash receipts. The prediction of payments is critical to reporting both within collections as well as with your stakeholders, such as the CFO or the sales department. Anytime Collect uses the data from average days late to project out customer payments on a rolling 5-week basis. So you can see the screen here. Those are all drillable, so you can drill into each of these categories and see the customer accounts and see their exact status at any point in time. So again, that decision making, the ability, the visibility behind your cash flows coming in. As mentioned earlier, sequencing gives you that ability to prioritize outreach at the right time. Here's an example of sequencing, automating a past due policy for a change in payment behavior. There's a rule that basically says if the customer's payment behavior has changed negatively, a request will automatically be sent to them for a promise to pay commitment. If that promise gets broken, a staff member's assigned outreach. This lets you catch issues early before the receivable is further delayed or quite frankly becomes uncollectible, because you would be able to engage the customer and understand why the change in the payment behavior and mitigate any of those risks as soon as possible. Our third metric is the cost of credit. When you extend credit to your customers, you have to finance the cost of goods sold to them. That financing can be your own cash, or it could be a line of credit or another instrument with a financial institution. If a line of credit is used, the cost of that credit includes the interest charges on the amount financed. If cash is used, the cost of credit includes the lost interest on that cash. Depending on the profit margin for your product, that interest expense can be larger or smaller. So the lower your profit margin, the higher that interest expense. And there's another cost of credit in here, which is the opportunity cost of lost interest on the profits from the sale. So if the payments were made up front, you would get that profit and you would actually be able to earn interest on it and increase your cash from operations. So, that cost of credit has a real impact. And the importance of knowing and managing this metric is that the cost of credit drives decisions that directly impact the bottom line and the efficiency of your receivables management. Any reduction in cost of credit is pure profit. Ultimately, understanding the total cost of credit is the key to optimizing the receivables efficiency. Now, Anytime Collect has two cost of credit metrics. They are the cost of credit balance, which is the sum of all the carrying costs for all invoices for that customer, both the current carrying cost as well as any past due elements. Cost of credit late is the sum of the carrying cost of just the past due portions of the invoices. So it's easily set. We actually have an option within our service to set the percentage rate that you might be borrowing, and that is then used in all those calculations for reporting and tracking purposes. Now, cost of credit metrics can be used in sequencing a number of different ways. So as you can imagine, you can set a threshold so that when a certain cost of credit is, in terms of financing or expenses hit, you may outreach to a customer and start to talk through them with that issue. You also can include those calculations directly within the communications. So as we talked about with AR sequencing, if you want to let the customers know, hey, you're costing, this invoice is now, a potential for a fee of X amount based on it being overdue, you can automate that calculation and provide it within the communication. So there's a lot of power in being able to leverage that metric within the process. So those are the top collection metrics that we wanted to cover today. And if we kind of summarize our discussion, the value of any metric is how it improves a decision that has economic consequences. As we said, AR is a process with lots of economic consequences, and we shared some of our, those with you. Now, the top metrics that we think need to be at the top of everybody's process and decision making. One is DSO. Why? DSO drives decision making regarding the effectiveness of your AR policies and procedures. Average days late, that drives the decision making of your most productive use of your staff time. Cost of credit, it drives the decision making on the efficiency of your AR policies and procedures. Now there are more, and there are very valuable metrics. We talked about them earlier, but when we think about the top three, these are the ones that come to the forefront. We do look forward to sharing more about these metrics and others in the future. So we hope you will be able to come back and join us on that. We hope you found this webinar educational and useful. And please join us for the next in the series, where we'll focus on how a portal can be used in your accounts receivable sequencing.